I think, Leslie, that the confidence has picked up because the economy, after stumbling in the springtime, has started to stabilize. And there's some evidence that maybe there's not an imminent recession. Yes, I know technically with 2 negative quarters of real GDP growth in the first and second quarters of this year, that would technically be a recession. But because of what's happened due to the pandemic, the numbers seem to be not holding up the way they normally would in a normal cycle. So what's happened is that the credit picture, and you put your thumb on it, that is the number one issue for investors. And you're right, the prime borrowers, which is the primary customer of commercial banks, they're not feeling any stress today. Now, yes, as you identified, some of the subprime borrowers, there is some deterioration there, but that's not the bank's primary market. The other thing, in the second quarter, what we saw, which was incredible, was the net interest revenue growth and net interest margin expansion because of the rise in short-term interest rates. And that's more than overwhelming any higher credit costs that the banks are starting to build into their models.
And the guidance on that front also surpassing expectation. Obviously, you note that credit quality remains strong. Depository rates, despite rising interest rates, though, have been quite low, which is helping that dynamic as well. Do you see a shift in that front? Is there enough competition out there for deposits to even, make some sort of a dent on that front?
You really are getting right to the heart of the matter when it comes to the net interest margin. We refer to it as the deposit beta. That's the amount of the Fed funds rate increase that a bank will pass on to their customers. But our banking system is flooded with deposit liquidity, and there's no rush for these banks to have to raise deposit rates. Now, granted, some of the deposits will leave because of quantitative tightening, and of course a custody bank like a Bank of New York, they have to pass on those deposit rates right away to their customers. But what I call, cheap consumer deposits, grandma and grandpa deposits, up in Buffalo, New York, those rates are not going to go up very quickly. The banks don't have to raise them that quickly. So those margins, to your point, are very strong and are going to grow again in the third quarter. Third quarter numbers are going to be very good.
Hey, Gerard, it's David. I notice you have holds on Goldman Sachs and Morgan Stanley. Given their moves lately, both have actually outperformed the S&P this year. Not by much, but by a bit. Why aren't you more positive on them?
Good point, David. I would say that we've been cautious and negative on them since the beginning of the year because of the expectation that the investment banking business this year was going to be weaker than last year. Now, we didn't expect it to be as bad as it's been. And that's part of the reason I think you've seen the stocks rally. As you guys probably know, the ECM business, equity capital markets, has been just devastated this year with the IPO business dropping close to over 90%. And so year to date, the deals have just not been there. But I think what's happened recently is there's this built up expectation that the fall is going to bring more ECM activity, possibly some IPO deals, and that will certainly help those names. We're not there yet. We still think the industry needs to realign its costs with these lower revenue numbers. Now, granted, the revenues we're seeing today are not the new norm because we're running at numbers that we haven't seen in 20 years, and particularly in the ECM business. So I think when we start to see some adjustments on the cost side, expense side, matching the lower revenue side, that could be the opportunity to step in and own these names.
Yeah, I'm glad you mentioned that, Gerard, because expense management has been used by some of your peers on the street as a cause célèbre. I mean, it really is their focus. Does it stick in your craw, at least the numbers we've been given so far?
Yeah, Carl, it's interesting because, you look at the SPAC business in particular, as you guys know, in the first quarter of 21, that was off the charts. And now it has essentially evaporated. And so you have to wonder, why do they have SPAC departments in the ECM business? So is there going to be deeper cuts in these areas? So there has been some minor tweaks, and it's understandable. Managements want to make sure that there isn't going to be a serious rebound in the investment banking business. And once they can be assured that the revenue outlook is more muted than it was in 21, that's when I think they'll step it up. So it's probably coming sometime in the fourth quarter.
Interesting. No, that's really important to emphasize. There have been minor tweaks to the various workforces, but not massive layoffs that we've seen kind of in other sectors. So really appreciate it. Thank you, Gerard.
You're very welcome, Leslie.